Assalamualaikum and hi everyone. My name is Miss Basira and we are now at the second topics for MAF603 where we are going to explore on the chapter of portfolio management and capital asset pricing model. These materials are prepared by referring to corporate finance textbook by Ross, Westerfield, Jaffe, Rosia, and Sheila. These are the learning outcomes for the whole chapter, but for this video, we're only going to focus on the first outcome, where at the end of this video, you should be able to explain and calculate the expected return, variance, covariance, and correlation for individual securities. For the portfolio, we are going to continue in the next video. What is individual securities? It referring to financial instruments that hold some monetary value and they often represent ownership interests in publicly traded companies. Individual securities also can be known as financial assets then that can be further categorized into three. First, we have debt security, for example, like banknotes, bonds, and debentures. Second category, we have equity securities. The example for this one is common stock or preference stock. And the third category here, we have derivative. Example for derivative can be like future or forward contract as well as the options. However, for the purpose of this chapter, we will focus on the equity security only, particularly on the common stock. Okay, talking about individual securities, we need to know their characteristic. So here, as you can see, there are 5 characteristics of an individual securities. First, we have expected return. Second one, we have variance and standard deviations. The fourth one is covariance and the fifth one is correlation. Each characteristic of an individual securities serves different purpose where we are going to look at each one in details in further slides. Now let's have a look on expected return first. This one is referring to the return that an individual expects a stock to earn over the next period. For example, if I were to invest in a stock that have 50% chance of producing a 10% profit and I assume another 50% that investment will give me a 5% loss, so I should expect a return of 0.5 times 0.1 plus another probability of getting loss is 0.5 times negative 0.05. So here beware of these negative signs because this one represent a loss. So if I complete this formula, I will get an expected return of 0.025, or if we want to put it into percentage, it is 2.5%, meaning that I expect to get 2.5% return from this investment. So here is the formula for expected return. This one should be your formula number 1 for this topic. How to find an expected return? You take the first probability times with the rate of return that you can get in the first probability plus probability number 2 times rate of return number 2, and plus if you have n numbers of probability times with the rate of return for n. Okay, so bear in mind that expected return is all about probability or just our expectation. The actual return might be higher or lower than what we have expected before. Okay, here I show you a simple illustration on how to find an expected return. Here we have two stocks, stock A and stock B, and we have 4 states of economy. Since we have 4 states of economy, the probability of getting a state of economy, like for example depreciation, is 0.25%. And for each states of economy, every stock here will give us different return. Okay, so if I would like to find the expected return for A, I will take the probability of getting negative 20% during depreciation, 0.25% times negative 0.2. So beware, here is negative sign because of the loss, plus 0.25% of getting 10% profit during recession, plus another 0.25% probability here of getting 30% profit during normal, plus 25% of getting 50% profit if the economy is experiencing a boom here. So plus everything, and I should get 0.175, or if we put it in percentage, 17.5%. We'll do the same for stock B. I take the probability of getting profit or loss for each state of economy, plus up them together. Here I will get 0.055 or 5.5%. So how do we interpret this? For A, stock A, if I invest in stock A, I would expect a return of 17.5%. While for stock B, my expected return is 5.5%. In terms of comparing their return, which stock is more profitable? Okay, so here definitely we will choose as stock A, since stock A will give us higher expected return based only expected return, not considering other factors. Moving on to variance and standard deviations, these two are measuring the risk for investment and an individual securities. By definition, it is how much variations or dispersion from the average or mean exists, meaning that how much your expected return deviates from the actual return. Variance is an assessment of volatility of a security's return. A low variance indicates that the data point tend to be very close to the mean. So if you get a low or small number of variance, it means that the actual return and the expected return is pretty much close. While on the other hand, a high variance or standard deviations indicates that the data points are spread out over a large range of values. So, like I said before this, variance measure the risk. For risk, we would like it to be as low as possible. Therefore, we are looking for a security that can give us a lower variance or lower standard deviation so that we can minimize the risk. Okay, next here is the formula for variance. This gonna be formula number 2 for this chapter. How to find the variance? You take the probability of getting this rate of return in state of economy number 1 times with the rate of return 1 minus expected return 1. So please note here, expected return, this one, we get it from the first formula. It means that if your first formula, you got it wrong, you might as well got the wrong answers for variance and it will lead to wrong standard deviation since standard deviations is the square root of your variance. Okay, so write it here. Standard deviation is formula number 3. Okay, another things to be careful here is to put the square sign here, kuasa 2, because students tend to forget to square this in this formula, which then results in them of getting wrong answers. Now let's do a simple illustrations on how to find variance and standard deviation. It is a continuation from illustration that we did before. We have stock A and stock B, and we already calculate the expected return for stock A. We got it 0.175 and expected return for stock B 0.055. Now we can determine the variance. Let's do for A first. Take the probability 0.25 times with rate of return 1 negative 0.2 minus expected return 0.175 squared. Okay, don't forget to square here, plus second probability 0.25 times rate of return number 2, we have here 10% minus expected return 0.175 squared, plus we'll do the same for normal and as well as for boom. Plus everything here, you should get variance of 0.06687 5. And if I were to find the standard deviation, I will just square root of this variance. I will get 0.2586, or put it in percentage, 25.86%. This one is the risk of not getting the actual return for stock A. Okay, we'll do the same. Put all the information into the formulas to find the expected return for B. Sorry, here is not A, expected return for B. Take up the probability for each state of economy and times with the expected return for stock B here, 0.0255, 0.055, the same one. Don't forget to square, and you should get variance for stock B of 0.013225. We're going to square root of this to get the standard deviation. Then we will get the SD for stock B of 0.115 or 11.5%. Alright, settle with the expected return and variance. Now we move to covariance. It is a measure of how much two random variables change or move together. If we have two stocks, like stock A and stock B, we would like to know what happened to the price of stock A if the price for stock B increase. Okay, so we would like to see their relationship. If the greater values of one variable, so let's say I have here stock A, correspond with the greater values of the other variables, price for stock A increase. We then see the price for stock B is also increased. Therefore, we can say that stock A and stock B is having a positive covariance. On the other hand, if the greater values of a stock variable mainly correspond to the smaller values of the other, the covariance is negative. Price for A increases. What happened to the price for stock B? Price for stock B decreases. This one, we can say that A and B have negative covariance. Okay, so here formula to find the covariance, formula number 4. We take the probability in one state of economy times with rate of return of getting A minus expected return A during the first state of economy times with rate of return B1 minus expected return B1. So if you see here, the formula is somehow look similar to variance formula, but here without the squared here. If we revisit the formula for variance here, after you have the rate of return A minus expected return A, then you're going to square. But for covariance, there is no need to square, but we're going to times with rate of return for B1 minus expected return B1. Plus, we do the same for the other probabilities. Another measures for relationship for two securities, we can use the formula for correlation. It is a measure of how two securities move in relation to each other. So basically covariance and correlation are measuring the same thing, which is the relationship between two securities. Positive correlation is when the values increase together. One security is having an increase in its price, so the other one is also reporting an increase in its price. While negative correlation when one value decreases as the other increases. One stock is having an increase in price, the other one will show a decrease in its stock price. This one is formula number 5, which is correlation. How to find the correlation for two securities? Before this, we have already find the covariance. So you just take the covariance between A and B divided by standard deviations of A times with standard deviations of B. So note here that correlation is related to covariance. If you have the wrong covariance, then you will have high probability of getting wrong correlation as well. Here in this slide, you can see that there are three different types of correlation. We have perfect positive correlation, meaning that your correlation equals to 1. Perfect negative correlation, correlations equals to -1. And here we also have correlations equals to 0, meaning that there is no relationship between two securities. They are completely random. So as you can see here, the correlation it has range between -1 here up until 1 only. While for covariance, you can have any numbers. There is no specific range for covariance. For correlation only, we have a specific range between -1 and 1. In terms of doing an investment, if you would like to see the relationship between two securities, we always suggest or advise to go for two securities that have negative correlation. Why? Because as one security moves in either directions, the other security will move in opposite direction. Let's say you have made an investment and it turned out that negatively you are experiencing a loss. If you have two securities that have negative correlation, one stock will experiencing or suffering a loss, a drop in its stock price. Another one will give you an increase in stock price. So the loss suffered by you will be offset with this profit. Therefore, if we would like to invest in two securities, it is recommended to choose securities that have negative correlation as compared to if both securities is having a positive correlation. During loss, both securities will give you a drop in its stock price. So here you will suffer a greater loss if you have a positive correlation for your securities as compared to if you choose securities that have negative correlations. Okay, let's do some calculations on how to use the formula for covariance and correlation. So for stock A and stock B here, we know that the expected return for stock A, before this we have find it 0.175, while for stock B we have expected return of 0.055. The SD or standard deviations for stock A, we have 0.2586, and for stock B we have standard deviations of 0.115. Okay, to find the covariance, we need to take the probability for each state of economy times with rate of return, this one negative 0.2, minus expected return for A, expected return A 0.175, times with rate of return for stock B. During depression, we have 5% return, minus expected return for B 0.055 plus. Okay, so just remember for covariance we do not need to put the squared sign. Plus everything here, you should get covariance of A and B of negative 0.004875. So we see the negative signs here, meaning that A and B is having a negative covariance, or they are having a negative relationship. What about correlation? The formula for correlation is covariance AB. Here we have covariance negative 0.004875 divided by standard deviations of A 0.2586 times with standard deviations for stock B 0.115. We should get correlation of AB equals to negative 0.164. As you can see here, if the covariance is negative, the correlation also is negative. How do we interpret this? If the price for stock A increased by 1%, the price for stock B will decrease since the negative relationship by 0.164. Okay, so this is how we find the covariance and correlation for two stocks, just to determine their relationship. Now, I want you all to attempt this exercise 1 and exercise 2 to test whether you can apply the formula, whether you know how to determine the expected return, variance, standard deviations, covariance, and correlation for an individual securities. We will discuss the answers for these two exercises in class group discussion. Thank you for watching. and I'll see you all again in another videos. Assalamualaikum.